All right, we'll begin the webinar. So welcome to today's webinar, Who Stole My Returns, Me or the Market? A different perspective on investment risks and forensic insights, hosted by CFA Society India. I would like to take a moment to welcome our audience from around the world, joining us remotely. I'm Kunal Sabnis. I work as Vice President at Nine Rivers Capital, and I will be the moderator for today's webinar. So before I introduce our speaker, I have a couple of housekeeping notes. Today's webinar is scheduled for 90 minutes, including the Q&A. We will be leaving time for Q&A after the presentation. Please feel free to submit your questions throughout the presentation by clicking on the Q&A link at the bottom of your viewer. Alternatively, you can also ask a question personally at the end of the presentation. The webinar presentation will be available to view after the presentation concludes in the chat box. We value your feedback, so please complete the evaluation survey just before you sign off for the day. Now it's my pleasure to introduce to you our speakers for the day, Vikas Khemani and Manoj Baheti. Vikas is the founder of Carnelian Capital. He has 25 years of capital market experience, most recently as the CEO of Edelweiss Securities, where he spent 17 long years incubating and building several businesses to leadership, including institutional equities and equity research. He's associated with several industry bodies and committees, served as a member of CII's National Council on Corporate Governance and FICCI's Capital Markets Committee. He was awarded the Young Professional Achievers Award for the service sector by ICAI in 2014. He's the avid reader, a poker player, enjoys yoga, meditation, and has been running marathon for the last 17 years. He's a chartered accountant by qualification and a CFA charter holder. Manoj Baheti is co-founder of Carnelian Capital. He has 22 years of rich and diverse financial services experience with marquee institutions such as Edelweiss Securities, Morgan Stanley, RIL, and HBCL. Manoj has spent 11 long years at Edelweiss as deputy head of institutional research and head of forensic, thematic, and mid-cap research. He's known in the industry for his non-consensus research and has pioneered differentiated forensic research, popularly known as ABC research, i.e. analysis beyond consensus. He has represented with various committees for the CFA Institute, including the chairperson of India Advocacy Committee. Manoj is also a fitness freak and has been running marathons for the last 10 years. He's also a CFA charter holder and a chartered accountant. It's my pleasure to welcome both of you on our forum. Over to you, Vikas. Because you're on mute.
Yeah.
Sure. Thanks.
Great.
Go ahead.
Thank you very much, Kunal, for kind introduction and also setting up this forum where we can sort of share our perspective on this concept on risk. So thank you very much for you and your entire team for setting up this conversation, and welcome all the participants for taking time out and joining us. We will try our best to build a perspective over next hour or so, and more importantly, we look forward to have your questions and interactive sessions so that we can have mutual learning and make it a lot more meaningful and impactful for all of us. So look forward. Friends, this is, we've been time and again, as we build this firm, we've been doing a lot of conceptual thinking in terms of understanding, various facets of investing. And I'm sure all of you also at your level, read, try to kind of, create frameworks in terms of how to think about various aspects of investing. And this is our attempt to, amongst many other things, which we found this is a very fascinating aspect, especially understanding on the risk side. As all of you know, that investing is all about risk and reward, right? But we think that risk is often sort of less understood or misunderstood, or subject where most people talk about returns, of course, which is important, no doubt about it. A lot of focus is on the returns, how to generate return, but I think risk is equally important, and many legends or legendary investors have kind of outlined the importance of risk in their own way. As Ben Graham would say that a sense of investment management is the management of risk, not the management of return. I mean, just clearly says that as long as you are managing the risk, returns will come by. Or as Charlie Munger says that, as long as you don't do anything wrong, things will come out, work out fine. And when Warren Buffett has said that, rule number one, never lose money. Rule number two, never forget rule number one. So that kind of again goes back to shows that what kind of some of the legendary investors have, put importance on the risk. And again, one of the another legendary investors, Howard Marks, has said that biggest investing errors come not from factors that are informational analytical, but from those which are psychological. And some of those we will discuss that as we go along. That what are those factors which kind of pushes us not to think risk in right manner. So our attempt is to kind of build a right perspective on how should one look at risk, in investing. Of course, returns is talked about a lot and there are various ways, but let us today spend time understanding and delving deeper into on the risk aspect of the investing. So this is our sort of attempt on that. Now, very, very interesting, that how much time, one spends on risk is very, very important, right? So there are risks which are control, which can be controlled, which can be managed, right? But if you look at how much time one should spend on risks which are controllable, manageable, theoretically speaking, or right in a right frame of mind, one should spend almost all his time, right? 70-80% or maybe 100% of time on managing risk, which you can manage, or risk which can be managed or controlled, right? But the practical aspect is that most people, at least in our knowledge or experience, spend much lesser time than it should spend on risk which can be managed, which can be controlled, right? And likewise, vice versa, risk which cannot be controlled or cannot be managed or very hard to manage, hard to control, right? Then you should be spending very less time, very little time of your investing time, but you end up spending a lot more time on worrying about those risks. So this is when we were kind of worrying about, when we were talking to a lot of investors, we found this anomaly very, very stark, that why people are spending so much time on worrying about the risk which you actually can't manage or can hardly manage. And once we put this perspective out to our investors, some of them have kind of really appreciated that their new dimension to risk management or new perspective on the risk management got opened up, because they were spending most of the time on risk which can't be managed and spending least amount of time or very less time on risk which can be controlled and managed. And this framework helped us to kind of create very, very insightful perspective on risk. So let us just see what are these risks. How do we see risk? We see risk in broadly three sort of, as we call basket or bucket, three type of risk. There are broadly three type of risk as we invest. We take, right? And idea is not to avoid risk. We are in the business of taking risk, right? So you cannot avoid taking risk. But when you are taking the risk, A, are you understanding the risk very well? And secondly, are you adequately rewarded for the risk you are taking? These are the only two aspects you should sort of spend your time on, right? So there's broadly three type of risk. Type A risk, as we call it, type A risk, which is the risk of permanent loss of capital, meaning you will lose between 70 to 100% of your capital, from the time you invested. That's the type A risk. Usually there are, only 2 or 3 major reasons for such kind of sort of risk or cause of such risk. A, you are investing into poor quality of the management or inferior quality of the management. B, you are into the, sort of investing in a business which is prone to high disruption risk. Or C, the quality of the earning or quality of, business is so poor that it can kind of lead to permanent loss of capital. So this risk is a very, very important and big risk, right? With anybody investing, will you lose your capital, right? That's the starting point. This risk is highly controllable, highly manageable, and where a lot of time should be spent. And we will talk more about it, how should one do it? But this is a very, very important risk. Type B risk is the risk of volatility risk, meaning M2M risk. from the time you bought the stock or any asset or any investment, the prices have gone down, or there has been a temporary loss in the quoted value of the particular investment. This risk comes from many factors, which are, which varies from, macro factors, could be local macro factor, could be international macro factors, could be geopolitical issues, could be, state elections, could be national elections, could be liquidity related matters, monetary policies, fiscal policies, or could be some temporary market dislocations, like we are seeing, a chip shortage or supply chain disruptions for many reasons. Now, these are the kind of, issues which do create volatility. These are the issues which do create volatility in the market, but they are not permanent in nature. But what we found, most investors in the market end up spending timing, expecting correction, trying to avoid a short-term volatility in their portfolio. Whereas, interesting part is that no matter what level of market, what level of index, what time frame you are investing, or what point in time you are investing at, this risk is always there. It is unpredictable. It can come at any point in time, right? Like, who thought, the pandemic, would come? It was a completely unpredictable risk. If you remember, December 19 was the time when economic recovery for India was very strong. The quarterly earning for December 19 quarter was very, very strong, and India was about to recover. And markets were doing all right, and suddenly this risk hit. So nobody could predict this kind of risk. And hence, in our opinion, unless you are a trader or unless you are a very highly leveraged player, spending time on this risk is not as desirable. And then this leads to us a very interesting third kind of risk, what we call risk of opportunity loss. Again, this, in my opinion, again, very, very least understood risk. Very often, people don't even pay attention to this risk. This risk, again, this means that you should have invested into type A asset class or type A asset or type A stock or particular stock, and you invested somewhere else, which gives you suboptimal return, right? The source of this risk, again, comes from two factors. All of us have long held human biases. They prevent us from seeing this risk in a right perspective, and we'll talk more about this. And secondly, lack of knowledge, your inability to, or your unawareness about, what are the various sort of opportunities going to be created in the market. As we know, investing is all about future looking, right? Forward looking, where the ball is going to be, and that's where you're going to be. If you are able to figure that out, you can be, a very smart investor, or you can come out very, very smartly. So, but lack of knowledge will always prevent you from having sort of avoiding this risk, or you are taking this risk without having, proper knowledge. This risk is also highly controllable, by the way. But you can, by awareness, by creating knowledge, you can very well manage this risk. But again, what we found, most people spend very, very little time on thinking about this, or effort on this. So once you see this whole framework of risk, there are three kinds of risk, and you understand nuances of each risk, you can figure out, how to go about it, how to conduct your time, what risk you should spend your time. And this awareness and time allocation, in my opinion, itself will start sort of reducing your risk or your risk return ratios. Now let us go deep into each of these risks. Type A risk, like we spoke about, that it comes from various aspects. The topmost being two, wherever you have inferior quality of the management. So we all know that whenever I'm assuming most of you are familiar with the investing world or are into investing. Whenever there is a fraud or poor capital allocation, governance issues are not there, and you can't trust management, or management quality is not sort of so high, you will always see high risk of permanent loss of capital. And there are numbers and numbers of examples where investors have lost companies which existed 20 years ago, 10 years ago. They don't exist anymore. And second reason is, again, business disruption risk, right? The business models which could be disrupted either because of technology or regulatory overhang or many other reasons. Like we don't have any more companies like BSNL, MNTNL only because of technological disruption or business model disruptions, or many such companies are there. I mean, Xerox could be an example, Nokia could be an example, BlackBerry could be an example. So whenever business disruption happens, model disruption happens, you will lose most of your capital. So these are the two major reasons where you will see, and there could be more, but these are two major reasons where one sees permanent loss of capital. And if you spend time on that, you will find that you are able to come out really well. And funnily enough, by the way, companies which don't carry this risk, also have characteristics of who deliver superior return over a period of time. So inverse is also true. As Charlie Munger says that, invert always invert, or tell me where I'm going to die, I will not go there. So again, very much similar kind of concept or philosophy applies here, that if the companies which don't fall into this kind of set are also the ones which deliver superior return. So you can look at whichever way one wants, right? So this also serves you both return as well as a risk perspective. But this is very, very essential. And at like in our firm, we have created very, very deep framework, what we call clear framework, PIU framework, and maybe it's a topic for discussion some other time. But my colleague Manoj, who's also on the call, which Kunal introduced, will talk about a little bit, more in detail post I talk on the risks classification, and to give you what kind of work can be done to avoid this risk. There's a detailed slides you will follow in 10-15 minutes. So this is how sort of one should look at type A risk. Now, let me give you the magnitude of type A risk. It is very easy to kind of say, but very often we will not understand what kind of risk it has, what kind of wealth has been destroyed by this type A risk. I'm sure when I'm speaking to you verbally, everybody can relate to it, but I'm quite sure that nobody would be seeing this kind of numbers can be destroyed with this kind of risk. Over the last 20 years, 32 lakh crore rupees have been destroyed by type A risk by approximately 570 companies based on our own research. This is twice as, and to give you context, the entire equity AUM of the entire Indian mutual fund industry is 16 lakh crore. Twice as much as the amount of equity mutual fund industry has been lost by type A risk in markets. Now that should give you idea about how serious this risk is. Right? 7 lakh crore been because of the regulated and business model disruptions, 14 lakh because of the various governance and corporate governance issues, almost 12% of the current market cap. Twice the size of Reliance. Now it takes 45 years to create Reliance, and so many businesses have to go right, and disruptions and all have to go right. But you see, twice of Reliance, almost 2x of the size of TCS. So this is the kind of wealth which has been destroyed. 1 out of every 12 companies carry this permanent loss of destruction. So if you have, let's say if you run a concentrated portfolio, if you get one stock wrong, it will have a serious dent on your overall return profile, right? So hence the importance of this risk is very, very, very high, and all of us must be consciously focusing on this. Little bit more deep cut on this, when we did deep dive of 118 companies, right? 55% of companies wealth destruction accounted because of balance sheet quality issues. Either they had a high leverage, again, lots of other ALM mismatch, contingent liabilities, and many things, and they have, there's a lot of deep work on that. Manoj and team has done over many, many, many years. I mean, he's been doing since 2007, I know. So he has deep insights into all of them. But if you look at, around corporate governance, 52% of the companies account because of, corporate governance issues have lost, the entire market cap. Even on the disruption side, 39% of the companies, have lost because of, disrupted or highly regulated business model. So across various, categories, if you see, if you do your work, if you understand how to study a balance sheet, how to avoid corporate governance issues, how to kind of see business disruption risk, what kind of red flags you should see in the forensic side, you can avoid a serious dent in your portfolio. And this is very, very important thing. Now coming to the type B risk, and Manoj will talk a lot more about how do you do forensic, some of the detailed insight he will give you when how to do forensic analysis, how to look at a balance sheet, what are the pitfalls you should avoid. He will talk a little bit more in detail in a while. Now coming to type B risk, again type B risk is the risk of market volatility. We all know that we live in a noisy world and how noise can impact our decision making. We all know, right? So we spoke about the sources of it is unpredictable. It can come from any source. We should not confuse market price volatility with the business volatility. Of course, business volatility you must pay attention to. Business model volatility you must pay attention to. But don't confuse market price volatility with the business volatility, right? So constantly we should ask, does this short-term volatility matter in the long run, right? But unfortunately, most people end up trying to focus on this management of short-term volatility. You must manage this if you're a trader. You must manage this if you are kind of trading on a leverage basis, right? But otherwise, it's completely futile to spend time on as long as you are convinced about the otherwise prospect of the business model and the company. But why do people spend? It's a very important question to ask. Because people do have the illusion of control. They think that I can time market. They think that I can kind of try to get it cheaper. You can get it cheaper or you can get it time market, but that is at best a fluke. I don't know anybody who has successfully over a time period of time again and again time in a perfect manner. I don't know any. Secondly, I think there's a huge conviction to action. I'm biased to action. We all kind of investing is about if you're a long-term investor, less active is actually boon. But most of us, especially in today's media savvy, high social media, low attention span world, action to bias to action has kind of disproportionately gone up, and is also reflected into nature of activity happening around. It gives people thrill. Some once in a while when you get it right, you start again feeling that I did it. The sense of I comes into the play. Right? And when you get it right, it's also instantly gratified. So some of these factors come in, makes us believe that it's a good risk to spend time on, and it's again keeps us busy, right? I don't know whether productive or unproductive, it keeps us busy. So hence these are the kind of reasons why people end up spending a lot of time on it. But you know what? Can you guess? Name of a company which, despite having corrected 17 times. 10% in a day, 8 times 25% over a period of 3 months, and having a 40% drawdown twice in the entire history of 20 years, has delivered 45% CAGR over almost 20 years period since 2002. It's up 1145 times. Now, if you know this context, and do you really think it's if you're talking about 45% CAGR return, trying to spend time on this intermittent corrections and trying to optimize that I'll buy high and sell, buy low and sell high, or I'll sell and get it back in at a lower price? A, it is not possible. B, it's a futile exercise. And many times when you look at, you will probably miss out the stock. The name of the company, yes, is Kotak Mahindra Bank. It has corrected many times, as you can see from the chart. You saw during the COVID period, during global financial crisis, it corrected significantly. So you will find many such situations coming about in the lives of companies coming up, but many of them might not have anything to do with the company's business. It may be because of macro environment. It could be maybe because of some extraneous factors which just are playing out in the market. It could be liquidity related. It could be shorter. Unwinding. Anything could be there, right? But fact of the matter is that if you can play out over 20 years, you don't need to optimize on those. And this is, by the way, repeated in company after company. TCS, again, a phenomenal company. Ever since it has got listed, it has given 29x return since 2004, 39% CAGR. Again, it saw significant drawdowns, 10% drawdowns. In a day, 10%, three times. IT, the safe business, unleveraged business, but still they saw 10% correction in a day. 25% correction from drawdowns over a 3-month period, 40% correction over a 6-month period. Now this kind of corrections have been seen, right? Eicher Motor again has seen similar kind of, which has delivered 40% CAGR since 2001, almost 1,000 times from there, but has given many sort of drawdowns, 10% drawdowns, 9 times, 3 times more than 25%. So these kind of correct, drawdowns have been there and will be there, but that does not make the quality of the business, quality of the management inferior. And as long as you believe in them, as long as you've done your business on type A risk, you will come out fine. So we've seen this in Bajaj Finance, Cement, HDFC Bank. All of this, that are phenomenal companies. We all have admired those companies, and they have delivered, unbelievable return in Indian markets, right? So if at any point in time you are kind of trying to optimize that, you might lose out on some of the sort of you will probably sometime you will get out at times, and you will miss out on the very, very big sort of rally which will come about. So very important to understand that it is, unless you are a trader, which is a very different profession altogether, requires different skill set, different focus. I'm not even talking this, I'm talking about only in the context of investing and long-term investing. It's futile exercise to spend a lot of time on this particular risk. Now let's come to the type C risk, which is basically risk of opportunity loss. As we spoke, it comes from two things: biases, long-held biases, and secondly, lack of knowledge about where the ball is going to be, where the and this is a very, very, again, important risk. Very often, if I have I have money and I have invested into an asset, suppose let's say I invested into a stock at 100 rupees, and if it is 120, I'm fine because I have not lost money. But what we don't realize is that if I invested this into elsewhere, everything has gone from 100 to 200 or 300 for that matter. Now, while you've not lost money, but you lost opportunity. You could have very well got this supernormal return or better return from what you remain invested into. Now, why does this, happen? Why this, people end up taking this risk inadvertently? It's according to us for two reasons: long-held biases. All of us are biased. Humans are biased. The way our brains are designed, including me, including all of you, we carry some biases. And because of those biases, it leads to us, to take this risk. Some of them, and this is not an inclusive list of biases, some of them I just thought it's appropriate to discuss here with you, so that you could be aware. All of us carry loss aversion bias or endowment effect, right? There is a lot more pain to take book loss than actually, gain of pleasure of booking gains, right? So assume that, let's say you bought a stock at 100 rupees, it went to 80 rupees, right? Everybody finds it very hard to sell at 80 rupees, even if you know that there's a compelling opportunity coming at, at that point in time, which probably if you switch into that, you could make 200 rupees. Despite having that intellectual awareness, your inability to book loss in your current stock, leads you to inaction and thereby missing the opportunity. Same way, there's not something called endowment effect, which means that you assign a lot more value to what you own than versus what you could own or something else which is happening in the market. Many people, own stocks for long period of time. Now, you kind of tend to have emotional attachment, and you are not able to see, objectively that, evaluate versus something else, what's there as an alternative. And after objectively analyzing, if you think it's what you own is fine, it's fine. It's not that, but that objective assessment of you own versus what something is elsewhere, is a very important thing to do from time to time. That will allow you to kind of, suffer from this bias and be objectively, looking at opportunities across the spectrum. Second thing, all of us suffer from anchoring bias. Very often, I have seen we invest. I mean, myself has suffered from that, and many times, if you, let us say, end up evaluating a stock at 100 rupees, if you will find very easy to buy that stock at 80 rupees because you are anchored the stock in your mind at 100 rupees. You will find it very easy to buy 80 rupees because it will come down. But you will not, because you are having a sense of getting cheap from the price you anchor. But if stock goes to 120 or 130, you will find it very hard. In your mind constantly, you will have a sense of overpaying. Whereas fundamentals of the business might have changed, earnings might have surprised you. Many people find it very hard to buy this. Or similarly, like if you bought something at 10p, and you will find it very hard to buy it at 15p because you're consciously in your mind tagged that sort of industry or stock at a right band of p, and how can I pay higher p for same stock I've been tracking for so long? I mean, many examples like chemical companies or IT services company where many companies have kind of said that many chemical companies cannot trade more than 10 times p, 15 times p, and miss that opportunity for a long period of time, and only to realize it later, and then you are being part of the crowd, and because of FOMO that you will miss out, you end up buying at 25 times P, 30 times P. So if you kind of miss out because of your anchoring bias early on, you will become part of FOMO, and you will kind of take higher risk at a later point in time, and you will kind of ride the boat if it is sort of sustainable opportunity continuing. So this again, anchoring bias can be in many senses. It could be about in terms of your style also. Many people say that I will only buy kind of sasta hai to acha hai, low P stocks are good. So we all know that nothing works in market permanently. Markets are ever evolving phenomena, right? So just because something is cheap does not mean good. It's cheap maybe for a reason, and I'm not advocating that buy at any price at any valuation is also right strategy, and I'm neither advocating. I'm just saying that we should not have a permanent bias that this is only how I will look at those biases are, once you get anchored, always work sort of against us in terms of tapping into the right emerging opportunity. Like today, many investors are struggling to look at the new age tech platforms which are coming about, how to go about that, right? So unless you evolve the new framework, one would constantly keep on struggling. Another bias which is the recency bias, that we tend to assign a lot of value to what recent events have happened, right? So if something has happened, our human mind is designed to believe that this will continue to happen or this will repeat itself, right? But that rarely happens. I mean, it can happen for a period of time, but eventually things change, right? So when the classic example is that you will see huge amount of SIP flows after market has done up well, after markets have kind of done well. Why only last month 25,000 crore SIP happened? Because most investors start thinking that what has just recently happened would continue to happen, whereas it should have happened other way around. Last year when the market was going down, everybody would thought that it's going to the pits and nobody put money, but the risk reward was other way around. Somebody who put money last year today is laughing all the way to bank, and to somebody who's putting today, of course, is taking much more risk than what investors took last year, right? And this is a very, very sort of big bias most people get. So people, other thing is that getting conviction around the price. Only after a price comes you get conviction, whereas the conviction should be around your detailed knowledge, your detailed work on the company and the business model, and your ability to evaluate risk reward of investing into company. If somebody did that last year, people would have and all the legendary investors have kind of deployed a lot of capital last year, thinking rightness of the risk reward that point in time. So this is what I think, again, a big bias which helps us preventing from this thing. Because these biases do impair our ability to take objective decisions. The important thing why I'm saying that, because we hold these biases, we are not able to take objective decisions, whereas investing is about taking objective decisions, right? And how do you constantly kind of do these objective decisions? So there are few recommendations at least I have, is that one has to constantly keep reading, expand one's circle of competence, keep reading books, keep reading what's happening in the industry, what are the new trends which are emerging, and connect dots. Of course, investing is all about connecting dots. So if you constantly connect dots, you will kind of constantly figure out that where the opportunity is going to be. So there's no answer to it's not easy. There's no answer to sort of hard work. Investing is simple but not easy for sure. So you have to constantly keep reading, and as they rightly say that it requires a very open, curious mind, adaptable mind, to spot new opportunity, new trends, or what's happening in the market. If valuations are going up, why they are going up, if a particular industry is doing well, why they are doing well, or if you can kind of anticipate little ahead, using some of the early lead indicators or macro trends, you could be again very successful at investing. Some of the trends which I have seen many investors have captured over the years. In 2001 to 7 period, when infra industrial boom came, I remember doing a thematic report when Edelweiss, on the entire infra industrial, and stocks became 10x, 15x in that period of time. Likewise, this happened in 2008 to 13 period, when the whole inflations came down and the Manrega created huge rural demand, all the consumer stocks kind of ended up doing very well. Became 5x, 10x in that period. Same thing happened, in pharma, IT, different period of time. Last year, we launched a sort of product around manufacturing and IT services. We believe that, pandemic brought two new big shifts in Indian economy, which is basically accelerated growth for IT services industry and in the manufacturing field. And today we all see in last 1 year how the stocks and sectors have got re-rated in that field. IT services stocks, when we started investing, were like trading at 15, 16 times P. Today, they are all in the range of 30 to 40 times P, right? And earnings have expanded. So, this is all requires a little bit of, hard work, reading, and connecting dots. But if you don't invest into that, you will miss out on the opportunity and you will buy only post facto, or you will buy when large part of the low-hanging fruit or early returns have been lifted, and you will probably capture only the later part of the lower return gain. So this is what kind of lack of knowledge or biases does to us. And of course, one has to constantly expand, move out of the core competence, constantly kind of adapt and learn. As they say that two things gets you in trouble: A, what you don't know, and B, what you know for sure. So, the reality is somewhere in between, right? So you should never know something for sure. And it's not that you don't know anything. And investing is all about being adaptable, being learning, being curious. And, legendary investors also fall into trap. I mean, Warren Buffett, whom I have admired all my life, and including Manoj, who all the time quotes him, denied for 15, 20 years investing into technology. That, I don't understand, hence I won't invest. And imagine, somebody like him whom he had Bill Gates as his personal friend. Now, I kind of can't understand that if you have Bill Gates as your personal friend, you can't get insights into technology, how it's evolving, and he could not have got those insights. I fail to understand, except the fact that he made to his mind very clear that, I don't understand, I won't learn. And, so even legendary investors can fall into this trap, according to us. So, and we have to constantly sort of all the time be curious, adaptable, and fight this particular, if we want to avoid this particular risk. So, in some summary, I can say that, if we focus a lot more on type A and type C risk, I have no doubt in my mind that, all of us can come out on a very, very right side of the investing, beating market handsomely without doing much, because these two things will set you apart from the crowd. Because crowd most of the time is worrying and spending their time on type B risk. So if you want to be away from the crowd, if you want to be smart, if you want to outperform, if you want to really do well, focus your time on type A and type C risk. And if you do that, you will not blame markets for suboptimal return. You will not say who stole my return. It is only you who are stealing your return, not the markets. So invest in that, and would be happy to take more questions once Manoj finishes his insights on the forensic side. Thank you. Manoj, over to you.
Thanks, Vikas. Thanks for simplifying such a complex thing in investing, which is risk. So let me try to bring some complexity to this presentation by introducing the forensic part. So first of all, good evening, my professional friends. Thanks for joining this forum. Let me share the presentation on forensic part. Yeah. So just to give you an introduction, like when we talk about forensic analysis, what is it? I would like define forensic into just one sentence. It is nothing but connecting the dots. Like if you read the financial statements and if you are able to connect the dots, not only ability to connect the dots, but willingness to connect the dots is more important. So that's, I think, the key thing when doing the forensic analysis. Let me 1 minute. Sorry about this. Yeah. Yeah, so let me just start this complex topic with a few things which generally I reflect whenever I do like a forensic analysis or whenever I look at a new company. So what are the things which one should reflect upon? And in fact, the best thing to get a solution is to just seek some questions. So let me just pose some questions on the screen. Yeah. So the first one is really a basic one, is that what should be the normal sequence of reading financial statements? And like the guys who must be hearing this, like they must be finding it is like too basic. But I think this is one thing which leads to creation of human biases. Like Vikas has explained that how biases disrupt objective thinking, how biases ends up selecting suboptimal investment. So generally, if you see the normal sequence of reading financial statements, even the way companies do present their financial statement, first you see the income statement, then comes the cash flow statement, balance sheet, and then finally the cash flow statement. Once you see the numbers in the income statement, there is some numbers which gets plugged into your brain, and like half the time people do not reach to the balance sheet, and even if they reach, because the kind of biasness which has been setting by reading the income statement, that is, I think, difficult to overcome. So in terms of like the way we read financial statement, we start with the balance sheet first. From the balance sheet, one can easily derive the kind of profitability which company has reported rather than looking at the income statement. And in fact, like one of the things which I would like to mention here, like history is the best teacher. Like if I see my forefathers, the way they used to read their profitability, they didn't have like a sophisticated income statement, cash flow statement. They just used to see the balance sheet. On the balance sheet, they used to see that what was my net assets last year and what is my net assets in the current year. And by taking the difference between these two things, they used to derive that what is the amount of profits they used to make. And the advantage of doing this is that you are not only looking the numbers, you are also looking the quality of assets which is sitting in the balance sheet. So that there I comes to my second question, that where is shareholders wealth position in the balance sheet? In fact, academically, we all are trained that net worth is on the left hand side of the balance sheet. You total shareholders capital and reserves, you get the net worth. But actually this is just a number. The actual net worth is on the right hand side of the balance sheet. Like once you look at the assets, see the quality of those assets, reduce the liability, you will see the real net worth of the balance sheet. And by doing this, you in your brain yourself will remove the suboptimal or the dubious quality asset. So that is the second question. In the next 3-4 slides, I will try to like go a little bit deeper into each and every aspect of this. The third one is that is the financial debt the only leverage one should worry? Quite often we say that, okay, this is a debt-free company. Have you ever spoken to someone, this is a liability-free company, or this is like a hidden debt-free company? So that is, I think, another thing one should dwell upon, that whether the reported debt is the true debt or there is more behind that. The fourth one is like we quite often talk about asset liability mismatch for banks and NBFC. But is asset liability mismatch only relevant for banks or NBFCs? Or whether manufacturing companies can also go down because of taking huge asset liability mismatch? In fact, there are numerous examples where like even manufacturing companies, by buying long-term assets, by borrowing short-term, even like companies, they have deployed their creditors' money into long-term assets. And that is, I think, one of the reasons that those companies could not manage their liabilities despite of running a superior business model. The fifth question is, like, quite often people say, okay, earning can be manipulated, but can reported cash flow be overstated? I would say that the answer is yes, but I would cover this in detail in the coming slides. And lastly is, can 1 + 1 = 3? In fact, I've seen many companies over last 12 years where like by doing some kind of complex structuring, promoters were able to do 1 + 1 = 3. And not only they were able to do 1 + 1 = 3, entire investor community has believed that 3 number and assigned the multiple to that. So this is a basic framework which I will be taking up in the forthcoming slides. So in this slide, if you see, like I have put like the basic framework of forensic analysis. And forensic analysis, as you read the heading, it is just marrying financial statements. So unless financial statement, all these statements, whether it is balance sheet, cash flow, income statement, and other relevant information in the balance sheet, unless they are talking to each other, unless they are in sync to each other, I think if they are not in sync with each other, and if there are large gaps, one should read that. And before starting the forensic analysis, one thing which we follow is, where is my profit test? Generally, people only talk about what is my profit, but what is more important is, where is my profit test? Unless you know that where the profit is getting deployed in the balance sheet, what is my profit is irrelevant. Second thing which I would like to mention here is, be aware of disappearing profits. In fact, in my entire career of last 12-15 years, I have seen various instances of disappearing profit. In many funny cases, the profit gets reported in the income statement, and a big portion of that profit, as high as 60 to 70% of that profit, disappear even before landing to the balance sheet. Like, forget about like taking the profit to the balance sheet, which gets added to the net worth and all. Even before landing to the balance sheet, that profit get disappeared. The second instance is when profit goes to the balance sheet, but it gets disappeared from the balance sheet after lying there for some time. Like, you will quite often see that the companies, after every 3, 4, 5 years, they are taking a big write-off directly from the reserve, which we call it, like in common jargon, big bath accounting. So that is another. And the third instance is, profit gets converted into some kind of assets, and that asset remain in the balance sheet forever, never get converted into any kind of cash flows to the investors. So this is, I would say, that the basic tenet where we I would put the context for forensic analysis. In terms of like various statement, when we start with the balance sheet, two things which are most important for us is that, what is the quality of assets which are sitting in the balance sheet? Are there significant non-operating assets sitting in the balance sheet? That's on the asset side of the balance sheet. And on the liability side of balance sheet, we always look at what kind of hidden debt the company is sitting. Like, is there some operating liability which is being classified? Is there some debt which is being classified as operating liability? In terms of cash flow statement, the one part is that how much earning gets converted into the cash flow. But the second part, which is more important, is the sustainability of cash flow, which I will touch upon in the coming slides. And so let me just go a little bit into detail, and I won't go in too much detail into this, given the paucity of time. So in fact, let me start with the most important statement in the financial statement, which house years and years of the shareholders' profit, is the balance sheet. So in the balance sheet, one thing which we always look is that cash conversion cycle only of the working capital asset. But is cash conversion cycle relevant only for working capital assets? What's about other assets? ultimately for long-term investors, all assets should have like a finite life, and they should have ability to get converted into cash flows for the shareholders, whether it is like intangibles or work in progress or fixed assets. But generally we look at like, okay, what is the cash conversion cycle of the working capital asset? Second risk which I briefed some time back is the asset liability mismatches. I think this is one of the biggest risks which even manufacturing companies do take sometime in their life, and those are like widely ignored by promoters, by owners, as well as by shareholders. And so if a company is funding long-term assets with short-term liability, then definitely the company is taking a huge solvency risk. The other thing is that the kind of non-core assets, like there are companies which keeps on generating tons of profit, but if that tons of profit gets redeployed into some form of loans and advances, ICDs, some dubious investments, so there is a big question mark, and there are examples which I will cover in the coming slides. The other part is balance sheet and income statement, whether they are talking to each other or there are huge gaps there. Like there are companies which keeps on reporting good amount of profit, but that profit disappears before lending to the balance sheet. So your profitability and balance sheet test fails there. So that is another thing. Plus there are like other obvious items which I believe all of you must be doing: ever increasing receivables, inventory, unbilled revenues, intangibles. And also one other important aspect is categorization of liability. Is it an operating liability or debt? Like quite often companies categorize their debt liabilities as a operating liability. Like companies do a lot of channel financing. Companies like do a lot of securitization of receivables. They get extended terms from their suppliers by giving them LC. So all that in true sense is debt, but company keeps on calling it as an operating liability. So, and also if you look for various off-balance sheet arrangement, like various companies have complex structure like JV subsidiaries, where a significant portion of debt is sitting. Various companies do right put options, like they may be selling stake in their subsidiaries with an obligation to buy it back, which may give a certain promised IRR or return to the investors. So that is also one of the risks which is getting ignored. So this, like once you read balance sheet along with notes to accounts, contingent liabilities, this kind of risk will be visible. On the cash flow statement, I would say rather than looking at just the operating cash flow statement, I think one should look at the sources of operating cash flow. And while looking at sources of operating cash flow, there are obvious operating cash flow boosters. Like many companies do quite often securitization of receivable, non-recourse channel financing. Now, it may be a non-recourse channel financing, but generally companies, even like one of the largest consumer company, means they have taken a certain portion of the default on them on the entire pool. So that is another way to boost operating cash flows, high payables. And then one should look at obvious gaps between income statement and cash flow. Quite often we have found various companies, even like one of the largest companies, there are serious gaps between the taxes, interest, exchange losses, which has been charged in the income statement and cash flow statements. Sometimes I wonder that whether this income statement and cash flow statement, whether it belongs to the same company or I'm reading two different annual reports. So these kind of gaps, I think, is something which raises eyebrows, and one should always question the non-cash adjustment. In fact, in terms of income statement, like one of the first statement summarizes everything, is like we like capex in the income statement, whereas we do not like OPEX in the balance sheet. So like today when we value any company like a new tech companies or a company which spends significant amount in brand building or customer acquisition, for those companies, the customer will pay them like for next 15-20 years. But the customer acquisition cost gets charged directly to the income statement. The question is whether it is OPEX or CAPEX. Logically, if I see it is a CAPEX, but charged to the income statement. So for new age technology companies, like when we see their P multiple based on reported earnings, it looks too expensive. But once we do adjustment for this kind of capex, which has been charged to the income statement, their reported profit should be much better vis-a-vis a manufacturing company which is allowed to charge all long-term investment to the balance sheet. So this is one thing which when we are looking at the income statement, we generally put a lot of focus that whether any kind of revenue expenditure is getting capitalized, whether the companies is charging lower rate of depreciation, whether they are delaying the expenses to the income statement. Then there are like various other parameters, like various companies have such a complex corporate structure. It is humanly impossible to put all the things and like do a proper connection. Promoter pledging, high contingent consideration. In fact, like one should read the derivative book and the kind of unhedged forex exposure which the company is taking, and there is a disclosure of all those things, but one should have patience to read all these things. Now let me just because this looks too theoretical, let me present some of the case studies, and these case studies are like published out of like our reports when I was in Edelweiss under the name Analysis Beyond Consensus, and this was the market cap of these companies when we have published these reports. Like there was a large telecom company with 81,000 crore market cap, and that time I think in 2012 or we have published the report and we have highlighted that how the asset got created in the company out of revaluation, intercompany transaction, and all those issues market was not noticing. A large pharma company with significant gap in taxation between their income statement and cash flow statement, with high contingent liability and related party transactions. So all those issues, a large media company which was reporting large profit, but that large profit was getting redeployed into giving loans and advances to various infra names. Even the cash and cash equivalent of that company was invested in some unknown overseas funds. There was a generic pharma company where like there was a significant divergence between reported profit and book value creation in the balance sheet. The company has even written large put option, high intangibles, deferred tax assets. Then there was an example of large automobile company, agrochemical company, and all these issues were very, very visible in the balance sheet. Only it required a patience to read those statements as well as connecting the dots. Now, this summarizes the impact of type A risk. Investors who have not taken consideration of these factors and taken type A risk. So the yellow bar represents the kind of market cap loss by ignoring this risk, and the green one represents the kind of profitability dip. Like many companies have gone from profit to loss. So that is 206%. So this is the kind of wealth destruction, and these are just few examples. And these examples are the examples where like we have highlighted this issue way behind in the past, just by reading the annual reports and connecting the dots. This is to summarize like how one should take the forensic. So we call it as a clear framework where we do a detailed cash flow analysis, liability analysis, earning quality, asset quality, along with the governance issue. And we have put a detailed framework around that. And by looking at these things, we are able to bring down the probability of type A risk, and this I think anybody can do. With this, I would say that yes, I'm on time. With this, I would conclude the presentation. And Kunal, we can open the forum for Q&A.
Excellent. Manoj and Vikas, excellent presentation, great clarity, and extremely technical what Manoj you presented. I think I was just thinking that we might need another detailed session with you, Manoj, highlighting the forensic research that you do. I think that would also be great. But we can open the forum for Q&A. All participants can have the raise hand option. If you can press the raise hand option, we can unmute you, and then you can go ahead and straight ask the question. As the queue gets assembled, let me just start off, right? First question is to Vikas. I mean, the analysis of risk that you have done and splitting what you can control, what you cannot control, excellent analysis. Tell me something, how has this risk splitting framework helped you invest better at Carnelian? And if you can share a couple of anecdotes, right, where you have either avoided the type B risk or and then the stock has become multi-bagger, or something like you have gone out of your comfort zone and invested something, basically targeting the type C risk, right? If you can give a few examples of it.
No, I think so. This has been part of our core philosophy, to be very frank. I mean, that's how we were able to kind of articulate this very well. One of the things, like we said, that there's no point in spending time on type B risk, that, it's not in your control. So what you could do is, find out type A risk tells you what, that, avoid inferior quality of the management. We do that. We have created our own framework that how do we judge management? How do we create, how do we decide what's a good quality management and what's a good quality business? And, it's there on our website also in detail, but, and there's a question in the chat box. So let me take that as well, saying that how to determine the quality of the management, right? Now, it's again subjective as well as objective. You can both ways, right? So we have created a framework, what we call IMPRESS framework, IMPRESS, right? So what do we do it? When we look at quality of the management, what does that mean? So what we look at, I stand for integrity. I mean, there's no compromise. People with huge amount of integrity is important. I mean, so we look at, is there a track record of any sort of past incidences, or when you interact with company management, you do your diligence on that, right? Then we like modest and capable management team. We don't like arrogant people. So, as long as the management team is modest, and they are capable in what they are kind of doing, on that parameter, we do a lot of assessment, right? Then we go back and look at what kind of passion, the management team carries. Are they passionate about what they are doing, or they are doing just like a job? We like in the later category when people are doing with a lot of passion, whatever they are doing, then only they can kind of build what they're building, right? So, and next is R, which is realistic and aggressive. So we like management which are growth oriented, but not, as much aggressive that they can kind of take any risk to achieve that growth. So we like people with a measured growth kind of approach. And if you look at some of the companies which we were talking about, even 30%, 40% result, you will find all of them carrying these characteristics of IMPRESS framework, right? E stands for efficient capital allocation. Very, very important. Managements, despite having all other categories, if they don't have this E, they will not create value. They will not sort of generate shareholder wealth, right? So capital allocation is very, very important. Then we look at skin in the game. If the management team has skin on the game, because it's very important that if they are successful, there is something good for them. And lastly, strong governance framework and risk management framework. Companies which have, so around these we do a lot of things, how we go about, in judging the management team. Once you are there, and if you also do, your assessment of the business, where we typically look at, again, we have a profit framework where we look at whether the business is profitable or not, opportunity size is large or not, cost of, do they have cost leadership or not? Do they have some sort of moat around the business? Is it easy to understand? It's too complex. I mean, so a lot of those things we have created in our, again, framework to judge the quality of the business. So once you do this, you are actually spending your 80% of time around these. You're not spending 80% of your time that what price the stock is, right? many times, so it has happened in our investing, like, we were looking to buy a stock, which was at around 200 rupees. And we were kind of still halfway our research, and the stock went to 240 rupees. And, in the process, now the temptation was that when you are halfway there, it's very easy to say that let's buy the stock, because stock price is already moving, right? But we said, no, let's take a pause. Let's complete our work. If it's okay, if I buy at 260 also, right? So the stock which we started research for 200 rupees, we did not buy till it was 260 rupees, but we made sure that, and we did our work fully convinced, and then we bought. And today, that time it was very painful, because you bought something at almost 25-30% expensive, but today the stock is 750 rupees. Now, of course it mattered if you bought at 200 rupees, it would have been better return. Right. But if you were not convinced, and the stock, let's say, did not do well, or for some reason, your research was not so good, you would have cursed all yourself that I should have bought something else, because we are not something high churn guy, right? So these are the kind of decisions you have to make, and especially in markets like this, when everything is running so fast, risk becomes all the more important. So hence, I would always say that anybody can generate return in this market. People who generate return with the lesser risk, are the right in my opinion, set of investors. Because when the tide goes down, we will know who was taking extra risk and who was taking less risk. Because that's the only time, we will know. Right now, everybody will look smart, and everybody, he's zero. So that's the reason I started with saying the risk is very, very underrated, or risk is very underfocused. Especially in this kind of market, it tends to be, underfocused. And hence we spend a lot of time on, spending on these risks. And type C risk, again, the reason why we could launch, example I was giving, IT services and manufacturing last year. In October, we started investing. We launched the fund in August, because our core belief was there. Again, it came from a lot of, connecting dots and research when we were looking at, IT companies in the middle of lockdown was winning contracts. So we said, hey, wait, last time around when the GFC happened, for 1 year, no contracts were won. But this time around, how come despite pandemic, companies are winning contracts? What is it that we are missing, right? So when we looked at that, we said this time around, digitization and cloud migration has become essential to their existence. No company can operate without digitization and cloud migration, and they cannot live without that. And as we spoke more and more, we kept on getting corroboration that this is going to be a super normal sector where, and some of the leaders made a statement that 10 years growth will come in 5 years. And it was a public statement, right? It's not that we were kind of doing some private conversation. So a public statement made by technology leaders. And when you connected the dot that if 10-year growth can come in 5 years, there's no way these companies which are otherwise considered a slow growth sector, will remain valued here. And we kind of overloaded on our sector. And we, in fact, today from that, our fund is up almost 100% from October last year versus index of 40%. So what I'm saying is that you could do it only when you were looking at where the ball is going to be. Same way in the manufacturing we did, because we believe that, if China plus one is happening, government is doing, a lot of things. And there's a huge, work we did on that almost for 2 months period. And we found that this is again a very, very big 10-year trend. It's a Y2K moment for manufacturing sector. And if it's a 10-year opportunity, you got to be early in that. And today also we feel that it's just going to pan out over a long period of time. And I find a lot of investors are still skeptical on the manufacturing side. So that's where I think, spending time on, this kind of concept, you spend most of your time. Many times I can tell you, we don't even know the price of the stocks which we own, for days, and that really doesn't matter, because you're not buying for days, you're buying for years. So this is what only thing I can say.
Correct. Absolutely. I think great answer. So the essential work that you put in to avoid your type A risk sort of gives you stability for type B risk and type C risk, right? And forensics is the main part of that. Hence, my second question is to you, Manoj. Is that you have done this for a long while. How has forensic analysis changed over the last 10 years, right? I mean, cons must have become smarter for sure. Annual reports have been becoming more and more glossy. You have professional guys who specialize in making annual reports, right? So if you could give your thoughts about how this has changed, if you could also time with to that, is that if a new company comes on your table, which are the few things that you will look first up in that company, just in order to decide that you should do deep dive or you should just sort of avoid?
Sure, Kunal. Thanks for putting this question. So whenever, let me first answer the last part of your question, that whenever a new company comes to our table, how do we decide that whether to allocate more bandwidth to that company, or like if there are red flags which are good enough that it doesn't deserve any more bandwidth from our research team. So what we have done, we have put a automated template like and all this learning we have learned from Indian promoters only. And as you rightly said, that every year you will see new innovations. Like in first 2 years of my forensic research, when I was doing, I was also of the impression that cash flows cannot be manipulated. But when Indian promoters, they have started doing that kind of things, even reported cash flows require adjustment. So this innovation keeps on happening each and every year, whether it is consolidation of subsidiaries, whether it is writing put option, whether it is classifying a related party transaction into a non-related party transactions. So all those things keeps on happening every year. In terms of like looking at the new company, so what we have done, like whatever things which you have seen repeatedly in the past, over last 10-12 years, that task we have assigned to the template. So once we put the ticker of the company into that template, that template will pull last 10 years of publicly available data from balance sheet, income statement, cash flows, related party, notes to accounts, and that template will do like various permutation and combination between these financial statements. In 3-4 minutes, you will get the first level of red flags. If those red flags are material enough, that is the time we decide that let's not go further. It is not our kind of investment. And while doing this, we have also left some of the money on the table. Like some of the stocks which our template has rejected in last 1 year, 1.5 years, those stocks have done well, but we are fine with it. Because if you have to avoid this kind of risk, and if your time horizon is beyond 1.5 years, then you have to like deal with this kind of opportunity loss. So Kunal, did I answer all parts of your question, or I left any?
No, I think most of it.
Yeah.
That was helpful. If I could stress more on the type B risk, right? The risk of volatility, and about timing or not timing the market. So you quoted Howard Marks, right? So Howard Marks in his book, Mastering the Market Cycles, gives a very classic simplified case for how to analyze the market movements, right? So if say market goes up in a straight line, sort of that's the average return from upward sloping from left to right, market will move around that in pendulums from optimism to pessimism back to optimism, right? And he basically states that you should try to get the best of it. Now at Carnelian, the framework is rock solid, but do you also try to time entries and exits based on that fluctuation in the market, be it from so if you want to enter at a pessimistic level or want to exit at the optimistic level?
Actually not. I mean, that's the precise point, that we don't try to time market at all, because that does not help, like I was giving an example that, we try to time our research, that we must do our research if, we have to be early on. So all those things are, required, but we really don't time to, at any point in time at that given price, we think that the risk reward of investing is there or not, right? And if we are convinced that, based on our analysis, that it's there, we really don't think that, oh, let's wait, take the market view. If market is going to correct, buy for that, because our view is to 3 to 5 years. And from that perspective, we look at. So that's the thought process. And again, you are supposed to outperform market. especially in business we are in. So, if you kind of keep doing, be part of the right side of the market, you come out stronger over over a long period of time. So we don't spend much time, to be very frank, Kunal, on timing or type B risk. Like I think that's a risk you should spend a lot of time only if you're a trader, not the investor.
Absolutely. I'll just take a couple of questions from the chat. There is one question on the tech firms, and that basically addresses the type A and type C risk, right? So in recent times, tech firms have created a lot of wealth, but there is a huge disruption risk also. Plus, a lot of people don't understand how to value these companies, right? How do you address that?
No, please understand that's the reason I think most of the accomplished and big investors are finding it very, very difficult. And that's a very sort of debate happening right now, that how do you sort of value these companies? How do you understand? And also, we don't know that how many of them will last today, because tech is a very, very disruptive sector today. New age tech companies are not only disrupting the old age companies, but they're also disrupting other tech companies, right? So it's a very highly and it's a very challenging. It's not easy, by the way. The only thing probably at least we try to look at is that what is the moat of the company? What is the are they in a monopolistic or network effect kind of business? Is there a competition in that? What are the potential disruptive forces ahead of that? So if you look at, let's say, companies kind of like Zomato, which is kind of gone public, they are almost kind of monopolies. There are very little sort of competition to them, and the growth will come about and high operating leverage. Now, so business looks fine. Now next you have to get your arms around the valuation, right? And this is a very challenging. Honestly speaking, all of us grapple, and everybody is grappling with it. And what also you worry about is it's a very, very sort of euphoric market, right? So in a euphoric market, I will take you back to sort of .com time, when a lot of companies were valued based on eyeballs, and how many eyeballs you had in your site,
clicks,
and many of those companies didn't exist or don't exist today. But internet was not a bad concept. Internet was a good concept also, but eventually it played out in a different form. In 2000s, real internet, if you know, players like Google and all those things came in 2006, 7, 8, and started kind of changing the game. But so there's always a euphoria, and then we think that consumer tech or tech-oriented plays are going to be relevant. Now, whether they will go through the same cycle as the .com bubble, or they will sort of scale up from here, I don't know. We don't have an answer right now. We are, as far as those things are concerned, more in a cautious camp than really a very, very because right now it's almost a fad and almost a very, very big sort of train everybody wants to get on. And there's a huge sort of value which has got created in the US, so everybody thinks that what has happened in the US will also happen in India, which most of the time is not true. So we'll have to see, wait and watch, but it's a very, very complex and difficult subject right now.
Great. If I look back at my experience in the capital market, right, which is about more than a decade now, some of the biggest errors that I have done is basically either pulling plug on great companies when they had faced transient headwinds, right, and which went on to then compound much better, or selling an investment, after a great rally in a short time frame, which basically you always think that you will time the market, and you address that perfectly in your type B race. What I want to ask you is that it's very difficult for guys who have spent years in the industry to stomach the volatility, right? How do you ensure that your investors do that? Because you doing it, or you as a team doing it, is still difficult, but you can still manage. But investors doing it, or you handholding your investors to do it, how do you manage that? I mean, how many calls you got last year in March, April on COVID lows, right? So if you could share your thoughts on that.
So sure. I mean, again, it's no easy, right? I mean, you try to build only long-term perspective. You build perspective. You show historical perspective that if you remain invested, how you come out strongly long period of time. And I give this very funny example. I bought a company, chemical company in 2000, 13, 14 period. The stock price was $40, and I got most of my friends buy that stock that point. But I was very convinced, and the stock became in a year's time 100 rupees, and I think most of my friends sold it because doubling in a year's time is a great return by any standard, right? And but most people sold, and I can tell you, because you can never make money on borrowed conviction, so you can always help people build conviction, you can help build perspective, but you can never kind of, if you are only anchored around the price. Now that same company, I can tell you today, I'm still holding. Okay, and it's 50x. Okay. Wow. Now point is that whom I told people, they did not have the conviction I had, right? So and the same company, by the way, had 30% drawdowns in between, but my conviction about the quality of the management, the quality of business is very high, and hence there's no need to sell. Now sometimes every company goes through painful periods, because of the markets or many other reasons. So if you remain invested for such long, you will sort of, in my opinion, come out. So what we try to do, we try to build perspective with the investors through different ways, and this framework also is a attempt to tell people that where should you spend time, where should you kind of think, and so you can only retain investors if you are able to show them the right picture and right perspective. If they remain anchored around the number, which is either a market cap or an index level or a price level, they will definitely get panicked. But if you can use data, if you can perspective, historical examples, overall knowledge, if you can build perspective, I can tell you investors sit through also. And I know investors who have kind of remained for long invested into equity for 10 years and 15 years. And those are the investors who actually make a lot of money.
Right. So there are a few questions on the type C risk, which is the opportunity loss risk. So I'll just combine them and ask you a question, right? I mean, this is the risk which is the least talked about, and it's very difficult to comprehend and quantify, right? How do you have any framework, or what suggestions can you give for people, for investors, analysts who are on the who are participating today, to avoid that? I mean, you may not avoid it, but at least lessen the extent. Some people have asked about the books you can read to understand biases and how to avoid them. If you can give your view on that.
So again, I think type C risk is a very if you ask me, complex risk, and according to me, while lot has been written and lot has been kind of it's to do with, like I said, two things, your internal biases and lack of knowledge, and both requires intense sort of work on your own psychology, and also work on your knowledge. In investing, actually, if you observe self, what are the things very often I think we don't observe ourselves, what are the follies we are making. The human tendency or human nature is to kind of look outside for errors and the blames and all those things, right? But we never kind of put ourselves into the bucket bracket and say, this is where I was wrong and this is what I did wrong, right? And once you start kind of assessing yourself objectively, and I invite always that I think find more faults with myself than others. So if you constantly evaluate your own behavior, your own follies, you will, over a period of time, I believe, that start refining. You will make lesser mistakes. You will always make mistakes. It's never that you can never make mistakes. You'll always be prone to, because human beings are biased, will be biased. There will be some other kind of bias will come about. Let's say, if we are constantly being successful, the overconfidence bias will come. And typically every guy who's made a lot of money in markets start taking loose bets, right? Now that is a part of the normal. So how do you constantly, and every bias has a different coping mechanism, right? Overconfidence bias, typically humble people are able to deal a lot better than aggressive and arrogant people, right? Now, so every bias will have a different coping mechanism. But I say that self-observation, self-analysis is a very important in my opinion. And if you can't do self, at least have a critique who can actually, and give him a full freedom, who can critique you, who can tell you that no, you did this wrong, constant. And that is where you will create that awareness of your biases. Either you observe or somebody else observes you, and that is how you constantly correct. And second, again, hard work, reading, and there are thousands books. I mean, book which I has huge impact on me. I can tell you is Poor Charlie's Almanac. It's one of the most complex book. I started understanding this book a little bit in my third reading. So, but once you understand, and the many books, it's not one. I mean, I'm sure all of you know that there are lots of books which are written, which are kind of which helps you sort of understand the psychological or behavioral aspect on impact on investing. And as far as the hard knowledge or the sectoral or knowledge is concerned, or the opportunity knowledge is concerned, that comes from reading, connecting dots, meeting people, ground level research. And by the way, a lot of it is common sense. It's not, it don't require a lot of complex, like in IT sector, when we looked at, we say, why companies are winning so large contracts when everything is shut, and how are they winning, and what is the implication of that? When we just read this in the newspaper and started exploring, you reached at somewhere else. One of the idea which is doing very well, I was referring earlier, actually there was a news clip item that they launched a new product in their field called Prime. And when we started examining that, what is new product, I think this is a new product we are hearing from this company after like 10 years. It means something is changing. What is it changing? And then we figured out that the CEO of the company has changed. That is how we started. So it's all about observing, connecting dots, and many times your research goes, by the way, futile. You reach nowhere and you drop it, right? So again, it's you waste a lot of time in doing research, but some doesn't work. So it's a hard work, and honestly speaking, there's no shortcut or short answer to that.
Got it. There is a specific question from Suketu Lalwani. He asked, I mean, this could be direct to Manoj. Is that, do you have a specific framework for financial services? These are a little different than normal manufacturing-based companies, where also in a financial business, generally, it's a leveraged play and the risk is on the balance sheet. How do you work for forensics for these companies?
Yeah. I think on the financial side, unfortunately, on the financial side, we do not have a cash flow statement. So how much profit company is generating and how much it is getting converted into cash, that is something which will remain missing. But there are like few things which one should look at while looking at the financial statements. The first one is like once you go through the contingent liabilities or hidden liabilities, like various banks and all, you will see that what is the kind of contingent liability which bank has written. So when you look at that, how much leverage the bank is, and vis-a-vis, if you add the contingent liability and see what is the true leverage, that is one. Second is like, if you see that a bank, what kind of sectoral exposure it is having, that disclosure is generally there, banks do disclose that. So that also gives you some perspective, like if that sectoral exposure, even during trouble time, let's say that a company is having a big portion of their investment into a real estate sector. Even during trouble time, if that exposure is not coming down, obviously during that time when entire real estate sector or infra sector is struggling, definitely the company is not going to lend fresh money to that sector. So other thing which is happening is evergreening. If exposure to the troubled sector is not coming down and NPA, GNPA of that company is not going down, it means that there is some issue, and that has happened like without naming the banks or NBFCs, that has happened with those companies. If you look at their GNPAs, even like during troubled times, that GNPA was not coming down, and the company like the loan book was not growing. The company was not growing its loan book. So that is, I think, second time. Third is that you have to go little bit beyond balance sheet, beyond reading numbers for these companies. So whenever we do invest in a financial sector, as you rightly mentioned, Kunal, these are highly leveraged balance sheets. You just have to lose 10% of your balance sheet and you are out of business unless you have a strong liability franchises. There are banks, NBFCs, which have lost 10% of their balance sheet, but because their liability franchisee was so strong, so they got like multiple options to survive and come back. And so that is, I think, another thing which one should look at, the liability franchisee. But most important thing for this, while investing in NBFCs, insurance companies, or banks, is the Impress framework, which Vikas has just talked about. The quality of management, the quality of not only CEOs, the quality of risk management committee, the strength of risk management committee. So all those things, when you meet them, you talk to them, what kind of risk management practice the company is employing, it gives you like, this is also a forensic, but this kind of forensic doesn't come just by reading the balance sheet in isolation. So a combination of all these factors put together will help you getting a perspective on the financial banks and NBFCs.
Got it. One extension of this whole forensic analysis is that gets into a bigger ESG concept, right? And recently, Professor Ashwath Damodaran expressed skepticism about the concept, and he claimed that the end game would be dreadful. I wanted to know your thoughts on this whole investments going into ESG, right? Is there a bubble in that? Do you think like that, or that's the way you believe the investments will go in future?
So, this is a new evolving concept. There's no doubt on that. And I guess as the world is, I mean, there are a lot of people, of course, has been promoting it. And there are a couple of views which has come about, like Professor Ashwath Damodaran, and I think, I forget the name of the gentleman who was earlier part of BlackRock. And he wrote a very recent good article about, how this is, froth and bubble. So I think the reality is somewhere in between, right? We all know that the world is moving towards more conscious, sort of approach towards environment, more conscious towards society, because the business operates in society and in environment. So earlier, there was a time when there was very little consciousness about it, very little sort of awareness and focus on it. But now the pendulum has swung on the other side, where as long as you are able to create some sort of broader, for want of a better word, a tick mark compliance, you get be part of a club and get overly valued because of that, and and a lot of money chasing only because of that. So some bit of a froth is getting built, and the cost implication of that also is very, very high, right? Certain today, it's like today a coal-based power is not even preferred, right? But fact of the matter is that, so a coal-based power is not preferred, but a EV which operates out of battery is fine, and that battery is getting charged from the power
from the coal power,
which is coming from coal power.
Right.
Now, so what I'm saying, somewhere right now, that imbalance is there, and these imbalances will get settled. But only I think time will say. India, I think, is just very, very early stage. So, but we actually focus a lot more. If you ask me, governance has been part of our focus any which way. There's no question on that. But we focus a lot more on governance and some bit on the social aspect, and there is, but environmental aspect still, I think, very, very hard. But if I were to look at our portfolio companies, if we are large in consumer tech, again, those are business we don't anyway have many polluting businesses, but most of our companies will be ESG compliant. But again, it's not necessary that every company which is not right now, because there's no standard framework around that.
Sure.
So coal power, we cannot wish it away. Today, hydrocarbons, you can't wish it away. World survives on hydrocarbons. So this transition, I think, is over a period of time it will happen. And I don't have a strong opinion to the extent that this is a bubble or not, but definitely, the right frameworks has to evolve. Currently, in my opinion, it is still not a very evolved subject on how to evaluate companies on an ESG framework. Still, lots of open-ended work is there. We are also trying to get our arms around it. But I think one should definitely be equipping oneself towards because sustainable investing is here to stay. World is also going through a transformative phase, towards more sustainability and all. So, and which is right, because I think humanity has, while become very, very comfortable the way we have lived, but also we have misused our planet, right? So to a great extent. So this part eventually will have to balance it out. So we went on the other way. I think probably right now there's a balancing thing happening. And if you look at a tightrope walker, when he tilts during his walk on one side, he puts pressure on the other side so that he can balance. So right now, I think that tightrope walk is kind of being pushed on the other side so that we all can be balanced. And I guess some balance will be found out over a period of time.
Correct. So I have two questions on US equities. So Hansi Merodra has sent in a question. She asked that, this is for you, Manoj. When you talk about Indian promoters can get innovative, do you have a sense if you can compare it to, say, companies in US on their financials, or basically developed market versus Indian market, sort of, if you have that, if you have any view on that?
I think one thing is that it is not India specific. If you look at it, is like once everybody knows the accounting rules, that this is the way, and there are choices. And there are like consultants who advise them that what is the legal way of recording that transaction. That legal way of recording the transaction may be quite different from the investor's way of seeing that transaction. So unless investor can convert that legal way of transaction, let's say even the companies which have gone bankrupt in US, despite of having like 8-notch management, top class governance, best rating from the largest rating agencies in the world, which have employed the best professionals. Despite of that, the companies have like mentioned that their derivative exposure was way more than what would have their balance sheet would have supported. And that derivative exposure, whether that was disclosed in the balance sheet, I'm sure, I have not read through that, but I'm sure that would have been disclosed somewhere in the balance sheet, or if somebody would have connected the dots, he would have known. So I would say that it is not US, India, developed or developing economies. Definitely the regulator or the kind of punishment which happens in those countries, it is more stringent. Like once you whereas in countries like India, it may take time. But as an investor, I would say assign means almost equal probability of things getting missed between a US company or an Indian company. That way, even like the companies which have adopted IFRS, which is like globally accepted accounting practice. And after adopting IFRS and getting a certificate from best of the auditors of globally, like those companies, in hindsight, we would say that they have misrepresented the information. But still, whatever information they have presented, they were legally right. Legally, they have not done anything wrong. It is up to the investors to spend some time on the balance sheet, connect the dots, and come out with logical numbers rather than the reported numbers. So that's the way I would like to conclude on this.
Got it. The second question on US equities is that there is a recently a huge hype on for Indian investors to get exposure in US, right? Do you think that there is some segment of exposure that is better there, or if you look at from the portfolio construct of an investor, do you believe that you should also take a US exposure in a part of your portfolio?
I think it's again a part of the overall journey of the kind of wealth creation cycle. And I think in last 5, 7 years, 10 years, India has seen a massive wealth creation, right? So when you have a very large amount of wealth, it is very natural for people to start thinking about diversifying away, only from the country risk, right? And in US, we all know that definitely there is a serious cutting edge work happens on the technology side. There's no doubt on that. Of course, there is a sort of all kind of things happen. There's a bubble also, but at the same time, the high quality cutting edge technology work happens. I mean, companies like Apple and Google only get created there, right? So and if you have to get access to this futuristic companies, that's the only way to do, right? And I think especially a lot of work is happening on the biotechnology, which is a futuristic area, which you don't have any access, opportunities out here. So if you look at from those perspective, I think definitely there's a case in point where one can look to kind of diversify away. How much to do, what level to do, what stage of your investing this thing to, it depends on a lot more individual situation than a generic one.
Got it. Got it. The next question we'll take from Monisha Wadhwani. She writes, given the current elevated valuations, would you put incremental money to work? I think you've answered that in when you said that you don't time the market. I assume that, right? Is that correct?
Absolutely, and I think we just to kind of we see a massive opportunity in next 3 to 5 years. I think while there will be intermittent corrections, I'm again telling you it's not that they won't be. Markets never go one way. Today, while it appears from all angles that there's a bit of euphoria which is there in the market, so I'm not even kind of ignoring that. But if you take 3 to 5 years, I think long way to go. India is into a very, very big transformative phase, and I guess we'll all be surprised with the kind of wealth India will create. So if you have that kind of view, it really does not matter because at least we don't know how to time.
Sure. You also mentioned about catching the IT cycle early, the shift in growth, deal wins, and what you mentioned. The next question is: Do you see the runway still in IT stocks? I mean, do you see a long runway in IT stocks?
Yeah, absolutely. I think India's export is about $165 billion. In next 5 years, this is expected to go to 250 to $70 billion. Now, this is the kind of growth in next 4 or 5 years possible or expected, and we all have been reading the kind of employment creation. I mean, IT sector this year alone has hired 1 million people, which is put together last 7 years. So that shows the kind of traction happening in that sector. So while of course the easy picking has gone away, the valuation re-rating part might have gone away, but I think compounding of earning growth from here still will be there 3 to 4 years. So you might not see the same kind of returns which we have seen in last 1 year, but now it will be more a earning compounding story than the re-rating story.
Got it. So you do a great research, get into the best names, forensics, stick with them through the volatility. How do you go about the exit strategy? Do you have any strategy? How do you sell stocks? When do you sell stocks?
I think great question. I think when we sell, first of all, when we think that our hypothesis has gone wrong, what hypothesis we invested with has gone wrong, or let's say there are some issues which we are beginning to notice either on the governance side. While after doing all other works also still you might see some sort of issue creeping up. Any those kind of signs we tend to kind of exit immediately. Or thirdly, when we see that it has played out really well and incrementally risk reward is not there. If based on our understanding, when we see growth, today, like I just mentioned to you, that despite IT sector having performed so well, we still see growth, and hence we are not kind of exiting. But the moment we see that growth potential, is given over next 3-4 years slows down, or whenever we see that, we will not remain invested in that. So we have to constantly keep evaluating the business part, not only on the price part. But when you think that the risk reward of remaining invested has gone out of, it has gone tilted against you, you will sell out. I'll give a classic example. We were invested into a company where they reported a significantly higher profit based on the inventory gains. We like that company, governance is so high, Okay, but because the commodity prices were going up, they had a huge inventory gains. Now market took that inventory gain as a permanent profit and gave almost, I think, 35 or 40 times PE to that. Now we saw that this permanent profit, it's not a permanent profit, but market is right now ignoring that. And it might happen that, so we took the normalized profit and we saw what could be next 2 years, and we found that probably stock might not go anywhere, so why to remain invested into that? And then we switched into something where we had a better idea, better risk reward. So we keep on looking at individual businesses where we think the risk reward has gone against you, and something else is offering better risk reward. So these are the kind of situation we constantly keep on looking at. But the critical factor is that as long as there's a robust growth ahead of it, we kind of continue to ride on that.
Perfect. We are through with most of the questions from the chat. I have two more quick ones. So let me just reverse the whole topic, right? We have spoken about risks, and we have discussed about risk of permanent loss, the opportunity cost, etc. Right? Tell me something. Do you have a sweet spot that you look in your companies, right? I mean, do you have a few quantitative traits in a company that you believe are a recipe for success, and that's how you sort of shortlist companies?
So, I mean, our sweet spot is what we call, we have given a name also to it, what we call magic basket. In the sense, so we love companies where we are seeing a change happening, changeover, a catalyst happening, right? So market is kind of, seeing, the companies have either not grown or companies are in a slow growth mode, and something changes which is going to put companies into high growth trajectory. So it could be like a change of a new management, or it could be change of a business cycle, or it could be which is going to last 5-10 years. There could be, or some new product launch which is going to put company into high growth trajectory. So whenever there's a shift which happens between from a low growth trajectory to high growth trajectory, for many reasons, you tend to see the stock not only giving you higher earnings, but also gets re-rated. And whenever you see combination of these two coming, you get supernormal return, right? So we typically look for constantly change of CEO, change of business cycle, change of any business strategy, new product launches. Whenever we kind of find that, we get very excited, and then we do a lot of work on that. So our true sweet spot is if we are able to identify companies where we can get both earnings growth and valuation re-rating. And if you see, like sectors I mentioned, IT or manufacturing, in last 1 year, large part of returns has come from re-rating, because the perception of the market has changed now about those sectors from the time what we look at. And of course, they are also growing at a rapid pace. But more importantly, whenever the market is not able to see the kind of insight or perspective we have about the growth or potential growth, you tend to do well. Of course, all other checks of governance and forensic and all those things has to apply. But the sweet spot we have is, where we can get both earnings growth and re-rating.
Perfect. That's great. My final question is, both of you have started Carnelian a few years ago, and you are building a team, a pretty young team. How do you try to inculcate this framework in the guys that who work for Carnelian, right?
By practicing, but Manoj can give you more insights.
Yeah, in fact, Kunal, the basic thing is like the best thing is like as I explained, like I learned looking at the balance sheet, looking at my forefathers, like when they used to see the profits from the balance sheet, not from. So in an organization also, it is the culture which matters. Like if every investment committee, you start first discussing with like what is the risk, what are the forensic issues, what is the clear framework, what is the impress score of the management. Like thereafter in means third or fourth meeting, like you are just participating and team is starting with that culture. So that culture gets built in an organization, and we like even in our investee companies that what is the culture which that company is building, because everything else is temporary, but the culture in the organization is something which remains for a long period. So that is something which is like we are happy to say that right now I myself spend minimal time on forensic. The team means comes with innovative findings, the kind of issues which is a learning to me also. So, and the template which I am talking, the team has done a lot of efforts, and they have built even the aspects which I have not thought of it. So that is all about culture, which we are saying. So I would say that once you transform all this to the culture and the team, then it goes in autopilot mode. Because you would like to add anything?
No, I think you covered. It's like best way to teach anything as a parent also to your kids is by practicing. So same way applies in organizations. So,
correct, correct. Great, both of you. Thanks a lot. Great presentation, great Q&A. I have learned quite a bit. I hope participants feel the same as well. I hope we can host you soon once again. So thanks a lot. And to all the participants, thanks a lot for being here. Thanks a lot for all the questions. You've been a great sport. Thank you.
Thank you very much, Kunal, once again, and your team for organizing this. And thank you all for attending and being patient listeners. Do reach out to us if you need anything further. Thank you.
Thanks, Kunal. Thanks, everyone.
I hope all of you have filled the survey. That is for our analysis. Thanks a lot.
Thank you. Bye-bye.